we're still playing for ultimately the market is down 30 to 50% from its peak because multiples still have to go down a lot more before this is all through.
Welcome back to the savviest 18,000 subscribers out there. You guys are amazing. Now, Dan Niles is a hedge fund manager famous for anticipating the COVID crash in March of 2020, among other things. He's been on Wall Street since 1990 and managing his fund since 2004. In a recent interview, he discussed his views about our current downturn. Against the constant flow of optimistic economists and investment analysts regularly predicting that the bottom is in, Dan was able to mathematically articulate how much further you can reasonably expect this market to go down before its ultimate capitulation. I thought that would be helpful for you all. As longtime viewers, you probably know by now I appreciate a sound mathematical approach. And if you've read my book, you know that I abhor the set it and forget it, head in the sand advice constantly shoved down your throat by mainstream pundits and unoriginal advisors. I've recommended you proceed with caution. I've warned about the risks of inflation. I've talked about the imminent recession. I've advised only investing in things you truly understand, and only after you've played out in your mind the possible downside risk scenarios as well, in addition to the upside scenario you're anticipating. Niles does a great job of articulating why I feel this is especially important right now. Here's what he said when asked about the way the market has been behaving recently.
I think this reaction to the Fed is relatively predictable because if you look back over Jerome Powell's history at the Fed, when the stock market has been up at least 1% during one of Powell's meetings, the next day it's down 5 out of 7 times. And if you even think about May, it bounced 3% the day of the Fed meeting, and the next day it went down 3.6%. So this is a pretty predictable pattern, and I think right now the stock market is dealing with the fact that you don't want to fight the Fed, just like you didn't want to fight it for the last 13 years when they were excessively loose. And you don't want to fight the fundamentals because numbers are continuing to come down. So for us, we're still pretty cautious. So we have over, I think 15% of the fund is sitting in cash. We have a fair bit of longs, but we're balanced that out with a fair bit of shorts. And I think we're still playing for ultimately the market is down 30 to 50% from its peak because multiples still have to go down a lot more before this is all through. Doesn't mean you're not going to get great bear market rallies along the way, but that's the ultimate what you're playing for and what you don't want to lose sight of.
If you've only been investing for the last 13 years, and honestly, my tenure as an adult in the stock market at least is only slightly longer than that. But if you've only been investing since after the lows of the great financial crisis, you're only familiar with how the market behaves when the Fed has an extremely loose monetary policy. When money's cheap, interest rates are low, that creates an environment that supports more and more zombie companies that only lose money for longer and longer. But a tighter monetary policy, which again, we haven't really experienced since before the GFC, a tighter monetary policy kills the weakest of the zombies, severely cripples the others, and brings the valuations of every company back down to earth, at least from a historical perspective. So at that point, it becomes incredibly important that you understand fundamental analysis. And as we've gone through some pretty detailed stock deep dives here on this channel, you've seen exactly how I like to break out and scrutinize those fundamentals and critically think through the different scenarios that might play out in the future. I love the math of it all. I love logic. And here's how Niles breaks down the math behind the broad market's fundamentals.
Let's just take the valuation part. Do we sink below the pandemic low of 14.7 times?
Well, absolutely. Because if you kind of think about it, if you look back over 70 years worth of history, when the CPI is above 5%, the S&P trailing PE is 12 times. If you want to be completely optimistic and assume somehow you get below 3% in the near term, the trailing PE multiple is 15 times. You're at 19. So to get from 19 times to 15 times, you still got to go down 20%. If you want to get back to 12 times, which is the average when it's above 5, and obviously we're above 8 right now, you've got to go down 35%. So, and that's not taking into account the fact that I think the majority of companies are going to have to cut their numbers when they report. Don't forget, Target guided lower 3 weeks after they gave guidance. Microsoft did it 6 weeks after they gave guidance. Intel sort of soft pre-announced 6 weeks after they gave guidance. These are massive companies that are coming out very quickly after they've already guided to cut numbers again. And I think it's going to get worse when you see what Q2 results are for the market in general when all of these companies have to report and guide.
Did you get that math? The PE ratio is price over earnings, right? So the price of the S&P 500 index is that number you see floating around. Right now, it's in the mid to high 3,000s. Its intraday all-time high hit earlier this year was just a little over 4,800, right? So that's the price part of this equation. The earnings part is made up of the relative earnings of all the S&P 500 component parts. So for the price of the market to come down, most people use the S&P 500 as the most representative gauge of the market. So for the price of the market, or the S&P 500 index, to come down, either the multiple is going to have to come down, or the E in this equation, the earnings, are going to come down. Right now, we're faced with compelling reasons to anticipate pressure on both, right? There was the historical precedent Niles pointed to for a lower multiple today. And we're regularly seeing earnings fall, quite obviously faster than even the companies themselves are able to anticipate. So Dan here is working through the math with us. Even if earnings stay the same, to go from a 19 multiple on your PE ratio down to a 12 multiple, that's another 35% drop. And remember, that 12 multiple is a historically relevant multiple for when the CPI is over 5. And we're over 8 right now. So that's one aspect of this calculation that is still on the conservative side. We actually don't have much precedence for what happens when inflation is actually this high. The other aspect is, as Niles points out, the earnings. If those continue to fall in tandem with the multiple, as they likely will given the inflationary and recessionary headwinds, that mathematically results in an even greater move downward. So how far could this go down? Do we just wait until we're down 50% from the highs and then magically we're good to go? Stupid question, John.
We're about 35% off the NASDAQ November high, I think. I think we're almost 25% off the S&Ps. So we only got 300 points to go on the S&P before we're in your zone, right, of 30 to 50% down from the peaks. At that point, do you shift your strategy at all?
Well, it depends on what the fundamentals are doing, John. I mean, if you think about, when the tech bubble burst, it took you 2.5 years to get to the ultimate bottom. Now, same thing with the global financial crisis. It took a while. But it didn't mean that you didn't get 5 rallies between 18 to 21% on the S&P 500, 5 separate rallies of 18 to 21%, while you lost 50% of your money over that period of time. So you're going to get these bear market rallies, sucker rallies, dead cat bounces, whatever you want to call it, on the way lower, because every 3 months or so, companies cut their numbers when they report. They say, and the investors go, oh my God, this is the bottom, it's a buying opportunity, the stocks are so low. And then the fundamentals keep getting worse and they go lower again when they report another 90 days later. And I think that's what you're kind of in for right now. So I'm watching the fundamentals to tell me when the ultimate real bottom is. It's not so much the price, but there's a time component of this that I think, unfortunately for investors, if you haven't been investing for longer than 13 years, which is the period of time the Fed's been just pumping up the economy anytime there was a problem, driving valuations absolutely crazy, you don't realize that it can take you 1.5 to 2 years during a recession to find the ultimate fundamental bottom. I think that's what we're in for because the central banks have just started to raise rates. They've got a lot further to go.
I think Mr. Niles is right. I think at this point, what he is outlining is the most probable outcome. But of course, there are no guarantees in the world of investing or economics, just probabilities. And I do think there's one possibility here worth mentioning. It's the possibility that sooner rather than later, these central bankers start to loosen their policy once again. They are kind of trapped between a rock and a hard place. I mean, they dug themselves into that place, so I don't feel bad for them, but that is the reality. With our national debt where it is today, there's only so far the Fed can push rates up to realistically fight inflation and it still be sustainable for us as a country. If you don't know what I'm talking about, watch this video next. When choosing between recession/depression or just prolonged inflation and probably still a recession, honestly, I think they'll end up having to lean into the latter. Either way, it's going to benefit you to understand all this and be prepared. I hope I can help. I wish you all the best. Take care.